Welcome back to Drawbridge Finance. Today I'm doing a follow-up video on how to invest $10,000, and I'm going to see how the portfolio performed over the last 14 months. And we're going to start right now. As always, welcome back to Drawbridge Finance. My name is Levi Woods. I'm not a professional investor. I don't work in the finance industry, and this is an opinion channel about money. About a year ago, January 26, 2018 to be exact, I did a video entitled Investing $10,000. And it talked about setting up a portfolio and the type of dividends that we could expect to see for the subsequent year that followed. And today I wanted to take a look. I just wanted to look at the spreadsheet and see what the performance was 1 year later. And now I've been a little bit delayed in actually getting to this. So I want to look at it 14 months later as well. Basically what we're going to do is we're going to look at whether or not the dividends paid out as I expected or as I predicted, whether they paid out a little bit less or a little bit more than we thought they might. And then we're going to compare that to the S&P 500 or the SPY index fund, just to see if there's like a correlation at all between the dividend investing or whether or not the S&P 500 actually outperformed it. Because as you know from watching my videos, you know that the S&P 500 or the NASDAQ or the Dow Jones Industrial Average are all index funds that we can invest in that, generally speaking, are better than most people themselves trying to like cherry pick certain stocks. Those index funds kind of typically go up and up and up over time, and we typically see a fairly large return on our capital. And I've outlined that in videos before. If you guys are interested in checking out the video on how to make a 7% or better return on average, you can check out the link. I'll put it right up here. You guys can click on that. And I'll also put the link at the end of this video. So if you watch through, you'll be able to see how to make a 7% return. But in this particular one, we're gonna dive in and look at 10 dividend stocks. Actually, there was one ETF in there, one growth stock, which was Apple, and then 8 dividend stocks. And over the past year, it's not been a great investment year. So really, this is an analyzation of what the performance was on those particular stocks and what happened month to month, and whether or not we actually made money off the dividends as I proposed that we would. The first thing I'm going to show you is the chart from last year. Basically, we had the price of January 26 of these 10 different stocks that we're going to invest in. And hilariously, somehow when I did this, I missed the Apple dividend. I just completely missed it. I don't know why. It usually pays around 2%. So we should have seen an expected annual forecast in both the percentage and the per share value here, as well as the total, which would have bumped up our total Canadian what we were actually expecting on the year. Jumping right into this, we're going to go from January 26, 2018 to January 26, 2019. So these are the same funds that were proposed. These are the prices we just looked at in the chart before. And these are the actual prices 1 year later. So you can see that almost all of these went down. KWH went from 933 to 530. BPF went from 20 to 17. Is there any that went up? Not a one. The entire portfolio went down, including this ETF. So we expected that here was the annual share forecast. And then this next column is a new column this year. And this is what actually paid out. So you can see I've highlighted the ones in green that were above what we expected. And the ones in red, which there's none of, were ones that were less than we expected. None of these companies paid less dividend than we expected them to last year. That was the current dividend yield, and that was based on last year. These were how many shares we purchased. Now this is the market value of 2018, and then this would be the current market value based on the January 26, 2019 numbers. So you can see where we're getting this data. That's the market value from the year before. This is the market value from this year. The total forecasted dividends were $649. What we actually received in this account was $670. We received a bit more than we expected. Now this is a number that updated including the Apple price. In last year's video, it only actually said we're going to make 636. I've actually updated that number because of my mistake. So 649 would have been the expected, and 670 is what we actually got. We expected a percentage return of 6.56%, and because some of those companies paid out a little bit extra dividend, we actually got a 6.77% return. Now, this is the type of long-term dividend investing strategy that I like to buy and hold, where we're just getting residual income all the time. So theoretically, we were going to get $54.13 a month for a $10,000 account. What we actually got was $55.87. Now, keep in mind, there was no transactions that happened in this account. We literally just bought once on January 26th of 2018, and then we've just held them. So The value of the stocks has gone down, but because we haven't actually made any transactions other than collecting the dividends, nothing has changed. We haven't actually lost any money until we sell. The cash, when I set up this account, was at $6.14. At the end of the year, with all these dividends paid, the $670 gets added into that. So we've got $676 in cash now. And we can choose to use that to redeploy that money at any time to buy more dividend paying stocks. So we can just take a look at the original investment was $9,900, and the value on January 26, 1 year later, including the cash, $8,843. If we chose to close the portfolio on January 26, 1 year later, we would be down money. How much would we be down? We'd be down approximately 10%. So 10.6% to be exact is how much down we would be, but only if we sell. What we actually have is more cash than we had. We had started with $6 in cash. We ended with $676. Now what I want to do is compare this. Like, how did this do comparatively to another market? So if we look at the S&P 500, which is one of the index that you guys hear reported on all the time, we know that we can track that fund really, really easily. So we can look back at these dates and say, okay, the S&P 500 fund, or the SPY, was at $286. And 1 year later, it was $265. It also paid a dividend of $5.08. And when we calculate the dividend payment in, it went down negative 5.49%. The S&P 500, a diversified portfolio, performed better than a non-diversified portfolio. Not surprising at all. This is why people invest in SPY. It's a simple investment, and it generally is a little more stable than something that's cherry picked like this one was. Now, because we had a rocky end to 2018, December, just everything was tanking, especially our dividend payers. I just want to flip forward and take a look at what the prices are now, and just to see some of the price recovery, because what's happened is the stocks have gone up quite a bit, the S&P 500 as well as the dividend pick stocks. So what we've basically done is I've updated this column. So instead of being 1 year later, January 26, 2019, it's now March 31st. And we can see the prices have recovered quite a lot. Some of these shares, like KWH was down at $5.30, is now back up to $8.64. PRV 230 is actually appreciated to 232. Apple's pulled up quite a lot. It's gone up to 189.95. We've actually seen some price appreciation on some of this. We can look at a scenario that's a little bit closer to what we would normally expect, rather than comparing to that downturn that was happening in December and January. So if we look at the total Canadian investment portfolio, at the beginning was $9,900, and now the value 14 months later is $9,673. And this is because the price fluctuation that happens in the market. And this is one of the reasons why I don't really try to time the market all that much. It's all about being time in the market, not timing the market. It's this rule like 13 on my list of personal rules. If you're not familiar with my list of personal rules, you should definitely subscribe to the channel. Watch the videos. There's a whole playlist out there. I'll put a link. Again, I'll put a link up here. I'll put a link at the end of this video down in the description as well, because that's super important that you guys are watching those 14 personal rules of investing. And that's really kind of my mantra about what I'm actually doing and how I'm making money month over month investing in the stock market. So the next thing we're going to look at are what the dividends. Again, we know that we were expecting $54.13 a month, and what we've actually received $54.81. Now, of course, some of these stocks pay quarterly, so it's a bit hard to figure out the monthly unless we look at the whole year. But this does give you a pretty good idea that we received a little bit more money than we thought we would have in a per month basis. So we originally expected to get a 6.56% return. What we've been averaging is a 6.64% return. We've collected $767. The cash balance with no transactions occurring has gone from $6 to $776. Now let's compare this percentage wise. What has happened to our portfolio? The total value from $9,900 down to $9,673. It's only been a loss of negative 2%. So now let's compare that to the S&P 500, because of course it has also adjusted. So if we look at that, it was trading at 286, and now today it's trading at 282, plus a little bit more dividend that's been paying out. And the total upside of that investment, had that route been taken instead, would have been a positive 0.7% return. So not the 7% that we're expecting annually, which is the average, because this was a below average year. So we might see a lot of appreciation in 2019, or we might see a little bit of retraction again. Generally, over time, we see this like consistent 7.8% appreciation in the overall market year over year. Just to wrap that up, looking at this comparison, this specific 10 stocks chosen lost 2.29%. The S&P 500 would have gone up 0.76%. In both snapshots, looking 2 months ago at the 1 year mark, and then today at the 14-month mark, both snapshots show that the S&P 500 has a little bit softer blow in a bad year. And we know this because of diversification. S&P 500 is diversified across 500 companies. And this portfolio was only diversified across one ETF and then 9 specific stocks. Really hard to get that kind of safety in diversification. Anyways, I hope this has been insightful for you guys. I know that there's always lots of questions that happen, so please leave your comments down below. I would love to read them. I love any feedback that you guys have because I love that we can just all get rich together. Remember to subscribe if you haven't. Click that thumbs up button for me because that helps the channel a ton. And if you're interested in following any of my trades, check out my Patreon page. There's lots of public posts there that I make. There's absolutely no charge to be a follower on my Patreon page. And you can see the types of posts that I'm making so that we can all just educate ourselves a little bit more. Thanks so much and see you very soon.